Yes.
Yeah, so you have Ryan for now. Pete will join in a little bit.
Sorry. All right.
Nah, it's fine. Pete and I usually come together, and humorously, I am in
Mm,
Pete's office right now because I flew out to
Yeah.
Nashville to visit him for a week. Uh,
Uh-huh.
so it's a little confusing.
Yep.
You want me to jump right in?
Yep.
Great. All right. So because this is John, I added a little bit of seasonal flair to this presentation, which you'll see in a bit. But we're going to talk about everything about managing early equity. A lot of this is geared towards the founder's perspective, but I think it will be helpful because a lot of what the founder needs to learn is how investors are going to see them or think about them, and what early actions they take might have some, significant ramifications later on. So, John, feel free to interrupt me if there's contextual questions along the way, and I'll be there for Q&A at the end as well. And Pete will join about halfway through. So, the seasonal edition of this is you want to protect your company. It isn't slicing pie, but the metaphor we always use is about pie and slices, and we'll get into that in a little bit. But the best thing you want to focus on in managing early equity is being sure that you have the flexibility necessary to keep your venture going. You don't lose control of the company at the wrong time, and you have a reasonable amount of dilution. So before we even talk about equity, let's talk about ownership in general. A common misconception is this is mostly going to apply to Delaware C Corps or C Corporation like structures. But a lot of times you will go and file for a Delaware C Corp, and you have to list how many authorized shares there are in the company. 10 million is the most common. You see a lot of people's thought process gets anchored into that 10 million, where it's like, oh, well, so a million shares is 10% of my company. That's not the case. Ownership is only ever based on a point in time of the issued shares outstanding and possibly reserved options. So getting away from the 10 million as my denominator and really focusing on what is my denominator at any given point, and strategically issuing equity to early team members and early contributors to ensure that you really understand that some companies can grow into their series, seed and series A, while not having all 10 million issued. 10 million is enough to play around with in the early days. It's enough to put meaningful vesting schedules on them when you're granting small fractional share ownership. But the denominator is always just what's issued right now. And so one of the bigger things, and we'll get into like fundraising with convertible instruments as well, those things aren't ownership either until they convert into some kind of share class. Usually that's a preferred shares later on, eventually common in the case of an M&A or an IPO. And the one thing to think about as a founder, you're only ever going to get more diluted. While looking for images about dilution, I learned something special. That is my cat, Iris. Apparently, there is something called a diluted calico, and my cat is a diluted calico because when I was looking for pictures of dilution, all these pictures of cats that looked like my cat came up, and Iris will return later in the slides. So here's a high-level example, or rather naive example, of what this dilution looks like. The example on the left is a super trivial example, never do this, but to really ground the idea, if I have a Delaware C Corp with 10 million authorized shares and I grant one share to myself, I own 100% of the company. If I grant another share to somebody else, we each own 50% of the company. And it seems simple and straightforward, but people often get confused when they're bringing on contractors or advisors and they're promising them X% of their company. You really got to be sure you're changing the numerator and the denominator at the same time. And you can see some other examples if this is a 66 and a 33 split, and they bring on a significant contractor or early employee. You can see that they both get diluted to give that 10% to the new employee. A lot of times people mess up the math and they're like, oh, if I'm going to give you 5% of my company, they think of how many shares there are now, and then they just figure out what's 5% of that. Always remember you're changing both numerators and denominators. So the first most significant grants are usually to the founding team. Now, not all founding teams are created equal. Not all founding teams start exactly on a smooth scale or know exactly who's going to be in the venture. So you want to think about some complexity and put some strategy into how you're doing your initial founding team grant. If you're a solo founder, going to use the 10 million authorized shares as an example throughout this deck, but if you're a solo founder and you're searching for a co-founder, you're probably going to want to leave room for their eventual grant. If you're a small team, you're going to have the conversation about who owns what percentage of this. Rarely is it ever equal. We'll get into some details on that soon. If you're planning on going to be included in an accelerator, if you're going to go and you're going to use contracting firms or something like that, you also might want to leave room for some equity. So if you're a 10 million authorized share company, generally the founding team will take between 6 and 8 million to kind of get them settled. You don't want to go too low because there's just some tax issues when you're filing your Delaware franchise tax if you've issued very little shares. As long as you go kind of north of 5 million in your first year, you're pretty all right. And the strategy and the things to take into account are, 2 to 3 founders figuring out their responsibilities all starting at the same time. You can probably hit kind of maybe 7 million issued to that, gives you some flexibility. If you really know you're the team, maybe it's 8 and then you leave 2 million reserved for a future option pool when you do a fundraising round to incentivize employees. That way you don't have to go and refile a charter amendment just to get more authorized shares in the company, which takes a whole shareholder vote. So the more people on your cap table, the more complicated it'd be. And if you're a solar founder and you're just not really sure what the future is going to hold, maybe something on the lower end of that to just give you the flexibility. Say you found your perfect match, you go through a program, you go to the Seattle Angel Conference and you meet some interesting people and they join your company. You don't have to go through a bunch of complex filing stuff just to get them equity that makes sense. So when it comes to the conversation, let's say we have the team and the team's like, all right, we're all in this, or at least we all say we're in this. This is what we're going to do. We're going to start a startup together. You're going to build the product. I'm going to go pitch the people. I'll raise the money. This is probably one of the most important early stage conversations that is shockingly easy to defer, or it's very easy to kind of get like handshake deals and promises that don't really net out, and founder infighting and stuff in the first year can really kind of wreck a company that might have actually, a good chance in terms of product and market, but just the misunderstandings in the early days kind of mess things up. So the skills that go into a startup are not necessarily intuitive to every member of it, depending on their background. Some people might overweight their importance if they're, they have a practical skill set like engineering, like, well, nobody can build the product but me. However, those are skills that are often commodifiable. They can be purchased on the market for cash. Cash is cheaper than equity when you think about the long-term version of a business. Other people bring something that is absolutely essential to the business, whether it's domain experience, a network, or something like that. And those things need to be weighted next to, who's going to be doing the marketing materials, who's going to be doing the pitching, and things like that. And it's really good to have this frank and open conversation amongst the founding team to really figure out where your role is going to be, where the intents are going to be, and make it so that it's not just assumed, because that could really start some fights later on. Fortunately, there are some good tools out there to help. We actually build one ourselves, and there's a couple other resources out there. And I'll show you a little bit about how our kind of tool works. Not really to show off the tool itself. It's a free tool. You can find it at cofounders.gust.com, but just the kinds of considerations that sometimes just don't appear to people. So this is a 3-founder company. Iris has returned again. You'll see what kind of role she takes on. Who's committed full time to it, who's taking a salary, who's actually, gathering the team, providing direction, who has that deep domain experience. And this is kind of painting a situation where Iris seems like an expert in the field, doesn't have the time, isn't going to be a product person, but seems to be really important in certain roles, like the technical issues. Nicole is paying all of the costs. Iris is my cat. She does not contribute to the household whatsoever, other than joy. Key pitching to investors is a very cool skit. There's a ton of these in our tool. We have about 50 or plus different relative weighting scenarios to help the founders walk through and actually think about the role that everybody's going to be performing, and then out pops an actual suggested split. Now, I would not go and take this straight to your stock grant documentation and issue exactly this, but going through the process informs the conversation so that we can actually say like, oh, I should probably actually surrender a little bit of that because I'm not playing that role, or I didn't realize that was so important to the venture. It's also really good if you're going to have founding team members that might not necessarily be co-founder committed, because it does take in, they might come out on the other end with 2% and be like, what the heck? I thought we were starting a company together. It's like, yeah, but it's my time, money, full-time job, deep experience that's going to make this work. You're kind of an early key employee, less of a co-founder. So once you actually get that founding team and you understand what those splits might be, you're going to have to actually grant the stock. Promises are not stock grants. An email that says, yes, we agree on these things are not stock grants. It's very important to get a grant done with a grant date, executed paperwork that's approved by the board, and actually signed off by the grantee and the CEO. So that's a big step. You're giving away significant chunks of your company. And so there are some protections that the company should use to make sure that if things don't go to plan, they're protected, and also that the people who are actually granting it are going to stick with the company for the duration that's necessary for it to be successful. So this is what's called common stock vesting, or you'll often hear it called reverse vesting. A lot of people are familiar with stock option vesting. In tech companies, you go and work as a contributor. Over time, you slowly earn the right to purchase a share. And they use that as an incentive for retention, compensation, and everybody participates in the growth of the business. Common stock vesting is not exactly that. Common stock vesting, once you get the stock grant and it's executed, you immediately own the voting rights to that grant. So if it's 3 million voting rights, you have 3 million votes. You are a shareholder. But from the company and the IRS perspective, because there's a vesting schedule on that vesting schedule is the company's right to repurchase shares over time. So rather than earning the right to buy shares, the company is losing the right to take them back from you should you depart amicably or not. This is a fantastic protection for companies because these shares are often granted at a time when the par value is really low. You're talking fractions of a cent, $0.00001 per share. And this is automatically built into the stock grant, or should be into the stock grant documentation, so that if something happens and a founder leaves, the company can automatically repurchase and pull back some of the stock, some or all of the stock grant, depending on how far after the grant date the founder left, so that you don't end up with what's called dead equity on your cap table. That's from an investor standpoint. If you show up and you're pitching to raise your seed round and 10% of your company is owned by somebody who's not there, who's not contributing, who left the company in a huff, but they still own a big chunk, that's a big red flag for investors because that's non-participating in the success of the company, the success of their investment, and now somebody's going to get rich for no effort. So what are these schedules? The most common industry standard founders vesting schedule, you'll probably still hear it all the time, 4-year with a 1-year cliff. The 1-year cliff means that nothing vests in the first year. This gives you, the founding team, the company, enough time to figure out if there's a really fit. Is everybody really in this? Does everybody have equal skin in the game? So, 6 months later, you go to a business plan competition, you're going to the finals of the Seattle Angel Conference, and it's just not working out. They're not pulling their weight. They can't commit. Or maybe honestly, just a life event comes and they say, I don't have the time anymore. I have a sick parent and I have to go spend more time with them. It's like, no problem. Exit the company, and the company automatically just buys back all the shares. So now the company's fully protected. 4-year, 1-year cliff is the standard. Every company could be a little special and different. The biggest thing is really think about that process is like lining up the period, both the length of it as well as the cliff, to mirror how long it's going to take to both understand if there's a good fit, as well as keep that kind of skin in the game style throughout the execution. There is some chatter in the space, and you'll see on some of the VC and startup blogs, companies are taking longer to go public. Acquisitions are taking longer. There's some people out there saying the new vesting schedule should be 6 years, not 4. Really look at it in terms of what's best for your company and what's best for the role, specifically the founder team. Say you have somebody who, well, maybe it's an H-1B visa thing, maybe it's a school thing. They can't be full-time on the venture until X date. So maybe the vesting schedule gets a year longer because they're not actually going to really see if they can fully commit for another 6 months or something like that. So this is the clear chart of what vesting kind of looks like over years. There's that cliff, so nobody gets any stock, and then usually it's just monthly vesting after this. First of the month, end of the month, you just vest 1/48 or whatever, how many ever years you did it. And a thing to note is you can always do subsequent grants too. So this is good for founding teams that might be, like I said, a little part-time. Maybe they're students, maybe they just don't know yet. It's a side project. Get your grants right and with comfortable vesting schedules for finding things out, because you can always grant more in the future. At some point, if the company gets very, very valuable, that might get a little expensive. But a lot of times it's easier to fix things by granting more equity than trying to claw things back or transfer things. Those are areas you generally want to stay away from with private stock, because there's all sorts of redemption rules, favorable tax treatment and compliance. I basically tell people, think about common stock grants as indelible other than the vesting schedules, because any try to movement around afterwards ends up getting expensive in lawyer time, expensive in tax accountant time, and can invalidate a lot of important statuses and exemptions that make holding stock in private companies very financially have a high financial upside. And of course, the IRS gets involved in this too. So normally, if you grant somebody just common stock with no vesting, they immediately own whatever they were granted, and that's an income event. So a really, really cheap company, if you grant somebody 5 million shares and it's all of $50 for the price of the company, that's not a huge income event, that's no problem. However, if you have vesting on a grant, what the IRS considers the vesting is each vesting point is the place in which the stock is now irrevocable from the individual. That's when they think the income event actually happens. It's not at the date of the grant, because technically the company could then fire the individual and get all the stock back. So by default, if you get granted stock, it's a private asset with a vesting schedule, the IRS is basically thinking, all right, you have 48 income events stretched out over the next 4 years, starting at the cliff, really. So I guess it's 36, 37. But they're thinking every month is going to be an income event. If you're successful at building your company and increasing it in value, 3 years from now, each of those income events might be substantial. If you're vesting 40,000 shares of your stock grant and your company has raised $20 million in venture capital, you don't want those income events privately hitting you every single month. So fortunately, there's a way around this for high growth startups. Basically, is an 83B election. That is you telling the IRS, I want to take the tax hit for that all up front. I'm going to take all the taxes on the whole 3 million that I'm granted in this calendar year. And then if you pay for the stock grant, which is best practice to do so, there's no income event at all, no issue at all. You got your stock grant. There's nothing on your taxes. You're good. The reason they allow you to do that is, and this is why it's generally only for high growth startups that are starting from the ground and going after fundraising, as well as like high margin scalable businesses. The 83B election is also you saying, I can't take any losses on this. Now, chances are these are the founder stock grants, so the stock is worth very little. So there's very little potential of significant losses on these. So it's pretty much always a good idea to do an 83B election. And it is still a very backwoods kind of thing. It needs a wet signature that has to be mailed to the IRS. We advise, and a lot of other people, mail it with a self-addressed stamped envelope. Probably haven't heard that phrase since like infomercials in the 90s. To actually send them confirmation back to you that they've received your 83B election, and it has to be done within 30 days. And they're surprisingly curmudgeonly about this. So super easy thing to forget, especially in the early days of startups, if you're participating in things and things are moving a mile a minute. But file those 83B elections. It's really a thing you don't want to miss. All right, so that's the founding team. So most companies figure out how to divide their equity and their ownership, figure out who's going to play what role, get smart vesting schedules, get those grants done and that equity split. And now you're pretty much set up for the founding team. But it's still too early to get an option plan. Usually option plans come with some cost and some compliance. So you might find yourself granting common stock to other contributors to the business that are not necessarily as big as the founding team, but are definitely going to help the company out. And it's an advantage for a company that probably doesn't have a lot of revenues or capital yet. So they can incentivize participants by giving them a little bit of upside in their business. These are always much smaller than the founder level grants, but they should still have vesting to fit the relationship. And we'll go through 3 of the most common ones that I lay out here. So advisors are a great thing for a startup. One, to really amplify the dedication of the founding team, is an individual with like double or triple the experience or the network of the founders, who's there in a part-time capacity to really help open doors. These are not just like, oh, a person in my slide deck I talked to one time about my business and they said it was a good idea. These are meant to be people who are providing real value. They're not as dedicated and they're not generally as building tangible as the founders. They're much more about introductions, partnerships, helping close a round, helping get acquired. Sometimes advisors might slip into a more contractor role where they actually do some real work. So think of like a lawyer towards the end of their career who is also really into startups, generally is an advisor, for the company, but then might actually enter a contractor relationship to do some actual legal work for the company, during a round or during a short period of time. But advisors are generally a bit more removed than that. Because they are brought on specifically to kind of help a company get to another level, to really like land a partnership or get a round closed, their vesting schedules are often much shorter. 2 years is the most common, with a 3-month cliff. Like I said, the value should be apparent very quickly, so that cliff can be a lot smaller. These are also usually industry luminary type people. So the idea that they wouldn't prove their worth in a short period of time, or that it would take an entire year, is less likely. And the share counts for these individuals, they're usually in the fractions of a percent, 1/10 of a percent, 1/4 of a percent. There is a great worksheet out there from the Founder Institute called the FAST worksheet. The worksheet is also married with an actual advisor agreement, which is very important. Get this agreement in writing. You don't want to put a big person's name in your pitch deck if you don't actually have real documentation that says they're going to advise your company. That also helps with like competition advising others. But the nice thing about the FAST worksheet is it gives you a little chart of like where your company's at and what kind of relative percentages would an advisor get. And it is all still those fraction of the percent, but it's how to make the decision between 0.2 to 0.1%, depending on the stage of the company and the experience of the advisor. The next people that might get, people or business entities that might get some common stock grant are contractors. A lot of times in the early days, startups can't afford a market rate. A software dev shop could be anywhere from $100 to $200 an hour for some of the premium pedigree ones. You need designers, you need, app developers, all sorts of things. So a lot of times you can get a below market rate by giving a little bit of equity upside along with the contracting agreement. Similar to the advisor, be sure you have the contracting agreement in place as well to outline the scope of work and the terms and protect the company. And then a follow-on grant. These ones are much more custom in terms of the vesting cliffs. It's all about what the nature of the relationship is. If it's like a marketing agency and it's going to be an ongoing relationship where you basically pay monthly for services that continue, is very different than a dev shop that you're going to go for 3 months to just get an MVP in the app store. So what we advise is always make the cliff and the terms enough that you will be able to feel the sort of delivery of the value that you're going after before you're giving up any of your company. So if somebody's trying to develop an app for you to get it in the app store, put the cliff probably based on the deadline or a little bit after that. So if they completely bungle the whole thing, you're left with no code, you're frustrated, they're mad, you at least didn't give, 0.5% of your company over to them. And the last, which is kind of like an advisor accelerator crammed into one business entity or a program, are accelerators. There's all sorts of accelerators out there now. You have your classics like Y Combinator and Techstars, which are kind of like the all singing, all dancing, full, like, they try to help startups in every way. They give them legal advice, they give them formation, product market fit, networking contacts. And then there's also very specific ones that we've seen kind of an explosion of in the last 2 or 3 years, some that are just about building your MVP or other ones that are just about raising a round. They have a very deep vertical and their compensation packages are all over the place. It used to be pretty common. They'd take anywhere from 4 to 7% of a common stake. And they would just induct you into their program and try to like grow you up and succeed if you succeed. That's kind of the YC model. I think YC still takes about 7%. How they take it is all over the place. Honestly, I feel like every cohort we see some new weird document from YC or Techstars or Mass Challenge or something like that. That is another attempt at getting into that cap table for the company and kind of sticking there. We used to see common with some dilution protection clauses in them that were a little heady to think about. We've seen warrants before. I think Founder Institute used to use warrants. I think they switched to something else. We've seen a fixed safe, which is really interesting. YC has done this at least once, where it's like we get 7% of your company immediately previous to the next preferred round, no matter what. It's kind of like a safe with a cap of a very arcane number, like 2.1 million or so. And as I'm saying this, somebody's probably drafting up some weird thing that we'll probably have to deal with in a month or two about how they claim it. The wariness you want to be here is the level of dilution protection. Depending on the pedigree of the accelerator, it might be worth it. But sometimes, things don't always go to plan. You might have to raid a bridge round from your seed round. And the more you have people that are fully protected from dilution, who don't dilute with the other people that are coming in later, the more that it might look a little fishy, for eventual follow-on investment. Or best case, the person taking all the dilution is the founding team. Early on, like I said at the beginning, all you're going to get is more diluted as a founder. So the more you can protect yourself at each step in the way, you don't want to set yourself up from the early days to be already diluted, right? If you only own 65% of your company after your seed round, there's not that much left to give out as you go up and up and up. And so another thing on the last point here, some of these other new accelerators that we're seeing are not even putting cash in. They're actually just putting services in kind in. It's not necessarily a bad thing. Sometimes it's completely worth it. Getting services or development help or something like that is as good as cash to startups at some point. But you want to be sure you understand the full scope of that and not conflate the kinds of money that some accelerators like YC would give 150,000 or so for maybe that 7%. Don't necessarily conflate that immediately to like, oh, I'm getting 150,000 of development resources. Like, put an extra eye towards that and make sure it really makes sense for where you're getting.
So Michelle asks in the chat whether it's better to issue a specific set of shares at the time that you're doing the work instead of one of these weird agreements.
You mean like if you're getting it with an accelerator or a contractor to just issue them the shares when the work is done?
Right.
Yeah, if you can pull that off, I mean, we're going to get into a big thing here. It's all about leverage when we start negotiating between these. So if you could say to a contracting team, like, hey, I will just grant you X amount of shares if this thing is done and successful, and they can agree to that, cool. A lot of times if they're giving a below market rate, they might want the compensation, both the equity and the cash negotiated up front. And a vesting schedule can kind of help, sort of like IOU handshake, promise it, and it might smooth the deal a little bit. But if you can get somebody to agree to it, I mean, you're in full control there. And I will say, if you do have repurchase rights in vesting stock, like the way they're built into the documents, it's not like you even need to get approval. Like if you're going to terminate the relationship with the service provider, whether it's a contractor or advisor, it's basically you just send them a notice that's like, hey, we executed our repurchase rights. They were built into the contract. We terminate this relationship. It's your cap table.
So she asks a little more about, I have 300,000 shares issues. I should just give them a number of them. I think she has a question about that.
Here, let me pull up the chat. Sorry, I didn't have it open on my other screen. So if you have 300,000 shares issued, that means they're issued to somebody. So that would be yourself or somebody else. So issued shares, you generally don't want to move around. As a founder, the reason why I say, like, if you have 10 million authorized shares, you issue to the founding team between 6 and 8. That gives you 2 to 4 million to play around with these other service providers and relationships. You don't have to use them all. Maybe you don't need them at all. The founding team was enough to do it. What you don't want to do is move your shares that you own to anybody else. That's what I was talking about. The indelibility is like, basically consider shares granted with somebody that's still with the company as just theirs. There's many, many reasons. The most significant one is QSBS. You want to hold shares for 5 years in a private company. You don't want to move them around. You don't want to redeem them for anything like that, because they could qualify for up to $10 million of capital gains, untaxed capital gains, which is a huge perk for both angel investors and founders alike. So usually you never think, and this is a great question in terms of a misconception that, like, oh, I will give you some of my shares. It's like, it's never like that. You will issue new shares in the company, thus diluting everybody who's already a shareholder in order to compensate those kind of relationships.
So can you go on to the next step, which is, okay, I've issued, 8 million to the founders. I've got 2 million for my key employees and other people that I'm mucking around with in flexibility. And now I go do my first seed round, and I'm going to issue, a 20% thing. I need to do something about that. I'm not issuing any of the 10 million, right?
Right. You're creating new shares. Yep. So normally the common stock is what founders get, early team members get. Investors do not buy common stock traditionally. There's some weird stuff changing around the crowdfunding landscape, but traditional angel deals and venture things is you create a whole new class of shares called preferred shares. And those preferred shares have a bunch of additional rights that common do not. Often they do vote. They're a preference stack, meaning that they get cashed out first in the event of a sale or an acquisition. There's a punch list of like 25 different drag along rights, tag along rights, pro rata rights, all these different things that you negotiate during that preferred round. Lawyers on both sides representing both the investors and the founders. And all those extra protections are why the company can sell those shares to the investors at a higher price than their common shares. So that's what you hear of as a traditional priced round or preferred round. And usually Series A and beyond will all look like that. So not common. They will eventually convert to common in an IPO scenario or something like that when everything gets to be even again. But companies will build up basically preference stacks as they do each subsequent funding round, creating new shares. And to do that, you literally have to file a thing with Delaware. You have to get a shareholder approval. It's like a big company action to create that new class of shares.
So I can create arbitrary kinds of shares with arbitrary kinds of rights. And so one of the places this comes up is when I'm doing angel rounds and I'm doing crowdfunding rounds at the same time. And so the two important things seem to be ownership in the sense of how much of the company I own. So when things liquidate, how much of the money I get, and control, which is when I get to make a decision and make a vote, or when I have to sign something, right? And so if I have 10,000 crowdfunding participants, I don't want to chase 10,000 people down to get signatures. So I might issue a kind of stock that is a crowdfunding stock that has no voting rights.
Yeah, we've seen this commonly with WeFunder and Start Engine. They're pushing companies who do crowdfunding rounds to just sell common directly, non-voting common, where the common is the voting rights for the common are actually proxied to the CEO of the company. And they're having the companies basically do a board-approved valuation to increase their share price. That's kind of new. I don't think we've seen enough companies that have gone through the full life cycle and the ramifications of that. But that's also the reason why with Reg CF, you have to work with a broker or a regulated Reg CF platform, because they will take on helping you navigate the complexity and be sure that you don't mess it up. What you don't want to do is just go sell your common stock for like $1 a share to private investors. That can get your company into some really sticky trouble when you're placing a value on the company. What is that value based out of? Is that an income event? Did all of a sudden everybody who owns common stock just, inflate their things? There's messy ground to tread there if you're not doing that through a Reg CF or Reg A round.
Okay. And so when you said QSBS, you were referring to the Rule 1202 work. And then you just said Reg A and Reg CF. And so maybe we should put a little context on what those are.
Sure. So anytime you raise funds or issue security, technically the SEC, the big Security and Exchange Commission, says if you're going to go sell securities to somebody, you need to register them. Registering them is basically like IPOing, which is a long and expensive process that most companies, even companies who have had some funding, do not want to spend the cash on. I've already said before that companies are choosing to stay private even longer. So instead of registering the securities, which involves getting audited and doing all sorts of stuff and filings and takes months and thousands of dollars, probably tens and hundreds, each company who's selling securities needs to file an exemption with the SEC to say, hey, I'm raising money, I'm selling securities, but I'm safe under this exemption. And there's a variety of exemptions out there. The ones that are most common and have been for the last couple of decades are what's called 506B and 506C. Those are private placements for accredited investors. They have some terms where they allow some accredit-ins, but it's usually almost never worth it. It's too expensive to get the small amount of unaccredited money you could, because you have to file a bunch of extra exemptions in each state you're taking money. But by and large, if a company files a 506B or 506C exemption, they can raise funds from private accredited investors, and they're under a safe harbor, and that's cool. So as startups exploded, retail investors wanted to get interesting. The Jobs Act came in. The SEC started making some changes to allow non-accredited people, so crowdfunding, to come into private companies. And
it's not going to work.
Oh, you don't think people have said that quite a bit. But so the one that's getting pretty popular now is Reg CF, which was actually regulation crowdfunding. And what the SEC basically said is, all right, you can take money from retail investors. There's some controls on the investors. They can't give too much of their annual income away and things like that. I'm not even sure how they're controlling for that, but they're saying, but in order to do that, work with either a broker dealer or a certified regulation crowdfunding platform, stuff like WeEngine or WeFunder, Start Engine, Republic, and they have teams that will actually help the company file the right things, message appropriately, file the right exemptions, have their marketing, approved. You can't speak about certain deal terms. You can't post in certain areas. They just help them navigate all that so that they don't run afoul of the actual exemption that they're filing under. And then Reg A is a little bit in between. Reg A companies, you'll see a lot on Seed Invest actually, where they're raising kind of an unaccredited round and also an accredited round kind of simultaneously under multiple exemptions. And each of those has little intricacies of like who you can take money from, how much, over what period of time. There's a testing the waters period that you can execute. And then there's also some like stoppages between when you take money from various audiences and when you have to kind of wait, like a holding period.
So when we come into a deal, the people that do the deal are essentially the company when they are issuing a round, right? And they have, each of these different rules has choices about when you can actually have to get registered versus when you actually make an offer versus make a sale, right?
Yep.
You have a lovely graph or something around that somewhere?
We do have something out there. We have another deck more around fundraising. I know the Reg CF one, which is the most important one, is there's a 30-day like grace period between taking money from any other sources. And it's like a rolling one. So like if you're a company that's taken some checks in from, accredited investors, people in your network, and then you want to do a funding round. And this actually trips companies up a lot in the early days when funds are tight, especially if they're trying to crowd fund their first round, where it's like, all right, say you took 40 grand from some people to get things off the ground. Then you're like, oh, we're going to go after a funding round. And you go and contact somebody like Start Engine or WeFunder, and they start the work. And they're like, all right, we had to wait 30 days from that last check until we can actually open up this round. But the paperwork's a little sloppy. You don't like how they marketed your profile. You have to go back and forth. They're growing really fast, so they're not responding to your support requests. It's 45 days since you took your last check. You still don't have your crowdfunding round open, and you still have to run it for several months before you get the cash. You're like, we need to take some more money to bridge us to this crowdfunding round to be over. It's like, well, now you're going to restart this timer. So now you take in another 30 grand to hopefully buy you a couple months, but now you have to wait another 30 days before you can actually do anything with that crowdfunding round. So it is something you want to be more strategic. It's definitely not free money out there. It's a lot of work. You do have to do audited financials. You have to work with these crowdfunding platforms. The crowdfunding platforms are learning this along the way too. We've heard a lot of feedback from people who've done Republic, WeFunder, Start Engine things that like, they're not all buttoned up and put together, and they're learning along the way too. Anything else on that, John?
Thousands of things, but let's get back on track with your deck.
Great. So let's see where we're at. The different kinds of common grants. A good segue. What happens beyond common stock? We talked a little bit about preferred stock, but another thing is stock options. We brought them up as the example of vesting in the beginning. Stock options, far more people are familiar with. It's the right but not an obligation to own a chunk of the company that you can exercise after it vests. Why would you want to adopt a stock option plan? Generally, if you're just doing stuff with common, like there's no real forcing factor until somebody is asking you to do so. Often at your first funding round, especially if you're working with professional sources of capital, they're going to want to see a chunk of the company dedicated to incentivizing employees. The most common reason companies raise funds is to hire. And so if you're going to hire a bunch of people, they're going to work at a startup. You probably can't pay them market salary like a big business or a big tech firm. So you're also going to compensate them with options. And angels and VCs want to see this because they want to be sure that you are going after that and that you are kind of a high growth, scalable company that they invested in and they can make an ROI on. So often the most times that a company elects to create an option plan is when they're doing a funding round, and they're kind of forced to whether they want to or not. It is a good idea, I think, to incentivize employees in that. Sometimes a company might elect to do this earlier for a couple reasons. John brought up there's kind of a tipping point if you have hundreds of people on your cap table as common shareholders, they have ownership. It's not that they can sway the vote necessarily. Like if you did a crowdfunding round and you didn't put people into like a unified vehicle, so there's just one shareholder, they're all individual shareholders. Even if they only own a 1/5% of the company, there's a lot of corporate actions you take where you need a shareholder vote or you need to provide notice and you need to do so in a certain amount of days. And it just becomes a headache to do those kinds of things if you have hundreds of common stock shareholders. It's far easier if you have option holders because they generally never exercise their options until they're already worth a bunch. So there can be a tipping point of just pure corporate back office management. There's probably a rule of thumb around in the tens. If you get some early stakeholders in there and it just becomes a little unmanageable, you might want to adopt an option plan. The other event is when your company's worth something. So you have to pay for your common stock grants. In the early days, they're cheap as can be. They're $10 for 1 million shares or something like that. However, 2 years later, if you've raised a bunch of funds, if you have revenue, if you've done some cool stuff, you've probably priced your company up higher. And if you're bringing on a teammate or just an engineer and you're saying, hey, come work at our company, oh, by the way, you have to pay $5,000 just to get your common stock. That's probably not going to hold water. And the bigger you get, the more expensive that'll be. So stock options are a way to grant employees stock options for free, effectively, so they don't have to pay for them up front. So companies that might be revenue, bootstrappy revenue generating and not actually need that injection of capital might still get an option plan in 2 or 3 years so that they can incentivize employees while they grow. Outside of that, options do provide a little bit more flexibility, not just the voting stuff, but the vesting is the reverse. It's the right to exercise. It's not those repurchase rights. Generally, option plans have a bit more flexibility of management. The CEO is generally considered the administrator of the option plan and can defer it to other people in the organization. And it's just easier to cancel an option grant, to change an option grant, to do things like that. It's not as heavy as common, where, like I said, you want to basically treat them as indelible. There is some tricky stuff though. You have to manage an option plan. There's some compliance to do as well. Some other things to look out for that aren't in common. One is called Rule 701. In a floating 12-month window, you cannot issue more than 15% of your company's ownership through an employee option plan. That's kind of a heady one to keep track of because it's a floating window. You might not have a CFO at the time. So one best practice is to just make sure your option pool could never be more than 15% of your company, so that you just couldn't do that in a calendar year. That's actually something we enforce on our platform. And another thing is just have good lawyers and accountants working with you while you're granting them, especially if you're granting a lot of options. And the other thing it comes with is basically you're probably going to have to get an annual 409A. 409A evaluations, they're not dictated to be annual, but the rule is you cannot grant stock options with a strike price that is more than 12 months old. So you'll get a 409A evaluation. I think we have a slide on them. Thank you to Enron for forcing us to do 409A evaluations. Their executives were abusing a loophole that allowed them to basically grab their deferred compensation earlier, right before the company went bankrupt. So the IRS came out with, it's probably subsection 409A or clause or paragraph or whatever. It's a whole body of law around these transactions, but specifically 409A evaluations is the industry parlance. It's a third party that's taking all the information about your company, your balance sheet, your revenue figures, your cap table, documents, contracts, and they're running a bunch of simulations based on similar companies at different stages in their life cycle, and they're coming up with the price to put on your stock options and your common stock. This is not what your company is worth necessarily to investors or to yourselves or to your market. This is what is audit defensible. Some companies said that you can grant stock options at this. You will often find this is much lower than the valuation that you hear about companies in the news, which is like pre-money valuation, $20–30 million or something like that. The 409A valuations could be half or less of that, just because the methodologies are generally not exactly to bake the speculation into the company or to go and sell the company, but just to hit the IRS regulation. And these things can be, oh, go ahead, John.
I'm going to dive into a rabbit hole here a little bit. We have this fundamental problem that we as angels invest in companies that are moving in spurts, shall we say.
Fits and spurts.
And in the process of doing that, we want to shift around stock between the investors, and to do that, we need to price the stock. And then the reflexive response is, we'll do a 409A, which is useless, functionally useless at the stage we're at, because there's no data points to put into the simulations for them to simulate anything. So are there other pricing mechanisms that are rational third-party pricing mechanisms that you can use as a proxy for price that is not a 409A?
So you can technically do what's called a board-approved valuation, where the board of directors just says, hey, based on this, usually some clause that you'd want to draft up with a lawyer, like based on this funding that we brought in, based on this speculation, based on another company that did it, whatever, we think our company is worth this much, so we are updating our share price to this much. Some companies do that in the early days when 409A is just, it's early enough, there's not enough history to the company. So that has been done before, definitely.
You could just do that as an annual retreat action, where you just do it annually, and now you have a price. And anytime somebody asks a crazy ass question, or somebody dies and their sister wants to know what to do with the stock, there's a number that you can give them, right?
Yeah, it can get into some dicey territory because I brought up audit defensible. So at some point when things are really going, when it's an M&A, when it's an IPO or something like that, all this corporate history is going to get unwound in this process. And every single time you value your company, you issue a security, you issue a share, somebody's going to raise their eyebrow at it and say, like, did this make sense? Is there possibility for fraud or misrepresentation or something there? So the reason why most companies go with a 409A third party is because they have, a history of standing up to audits where the IRS will come in and be like, well, why did you say this company was worth this much? And like, well, we ran the Black-Scholes-Merton formula on it. We compared it to these public companies that did this. We compared it to other startups that rose this. And like, this is the number that popped out of our system. And the IRS will usually say, okay, that's a reasonable way to go about that. Like I said early on, if the company is doing a board approved valuation and it makes sense, it can probably hold up. But the more complex the company gets, if it's year 5 and you're granting stock options and your board is just like going on an offsite and like rolling chicken bones and being like, it's $3 this year, you could get yourself into trouble in a future deal if there's not a lot of backup to that. And usually it's these third parties that provide the backup in the safe harbor.
Right. Yeah, sorry, I'm joining late and
hey,
jumping
Pete.
in. But hi, I'm Peter, also from Gust. Just wanted to note, John, that one of the things that we have seen working across the spectrum of investors, founders, and foreign evaluation firms is that the data everybody uses is usually very much the same. All right, so they're assessing team strength, number of years in the industry, previous exits, previous ability to raise. They're looking at the total addressable market. They're looking for comps in that market with a similar business plan. They're looking for a business plan that points to some sensible revenue stream. They're looking at whether that's B2B or B2C, and then they're looking at any type of traction. And then what gets interesting is from the 409A perspective, the goal is to make it low enough and reasonably justifiable. The goal from the founder perspective is to make it high enough and reasonably justifiable with the money that they're going to take in from the investors. And the goal for the investors is to land it somewhere in between. But given all of those inputs, a valuation at the low end and a valuation at the very high end on a relatively wide spectrum are all reasonably justifiable, which I think is what makes all of this interesting and very challenging for early stage private companies.
Yeah, thanks, Pete. Nice to see you.
Exactly. Yeah, thank you.
All right, so I think we have a little bit more here. Oh yeah, so the last bit we got is talking about option pools themselves. I love this Pools Not Ocean. I stole this from Jose Anser, who's a startup lawyer with Egan Nelson. He's got a great blog. It's very founder oriented and kind of like backing the founders parts of startup land. So when we talked about a funding round and getting those 409A valuations to price your options, an important thing to note is the option pool that you have is basically reserving a chunk of your common stock designed to incentivize employees. And like I said, often it will be insisted on by professional investors. What to set that pool is not something to just go Google and say, how big should my option pool, plunk it in. That percent you set it, especially your first option pool, is going to set the precedent for every future round and how much that gets expanded or not, as well as how much dilution goes onto the founding team. 2 factors weigh into this. One is the vast majority of fundraising instruments include the unissued option pool in the company capitalization. So that means even if you've never issued any of the options that you reserved, that chunk of your company is still going to be used in the denominator of the math, which means that you're going to take that dilution, even if it turned out you didn't need those at all. So you'll see on the internet a lot of people like 20% or 15%. Don't just grab those numbers. Take a look at where your actual hiring plan is going to be, the staff you're reasonably going to want to hire, back it up, justify an option pool that's just as big as you need it. Because the costs of expanding the option pool, if you just have to hire more than you expected, are far outweighed by the costs of diluting yourself round after round just because you stuck with a 20% standard that the investor or the VC said, oh yeah, everybody goes 20%. And they are poorly incentivized to push for a bigger percent because it will lower their price that they can purchase so they can get more shares for their investing dollar. Sorry. Cool. I think that is the end of it. Shameless self-promotion. If this sounded like a lot, we have a platform that takes care of a ton of this stuff, from option pools to equity splits to signing these documents and being sure everything is taken care of. Check us out at Gust Launch. We love this stuff. And we're also around, hanging out with John,
Yeah.
helping people out,
Yeah.
providing support and whatever we can.
So before we open it up for questions, I want to ask you to dive in a little bit into the valuation question. So we find that, they go into Gust because we use Gust. They fill in the paperwork and you say, how much are you raising and what's your valuation? And they type in a random number and they want it to be a big number. So it's a big number. And they listen to all of the blogs in San Francisco, which make it an inordinately big number. And then we get cranky and then we push on them to try to make that a different number.
Yep.
And so can you talk a little bit about how, two guys in a garage with a dog, an idea, and a bunch of dreams get to a valuation to put in that box on your thing that doesn't cause that fight?
Yeah. So Pete and I both have some fun experiences with this. So it's worth saying, we mentioned it kind of sideways, but the word valuation is ambiguous in the startup world. 409A valuations, like John said, are fundamentally not like what people use to negotiate how much money they're raising outside of like a little bit of justification of like a floor. The valuations that you hear about in the news coming out of TechCrunch and Silicon Valley, like raised $5 million at a $30 million pre-money valuation. That pre-money valuation is the agreed upon priced value of the company for the deal that you negotiated with the investors that are putting the money in. Usually when you're applying to investor groups or whatnot, and they ask for your pre-money valuation, they're asking you what you think your company is worth based on what it's done so far, the value it's created and been able to capture so far, with a little bit of also like where you're going to grow, what are your prospects, what are your opportunities. Making those numbers can get huge for companies that have ridiculous, have no assets, have no traction, don't even have revenue streams. You see some crazy ones all the time. But the practical approach to that is to really consider when some competitive analysis of what other similar companies have done and raised is used. It's what investors will weight it against. But it's also just taking into factor what Pete was talking about is like your team strength, the traction so far, how big your market is, how much of it is reasonable that you could capture, what your margins look like. Putting all that information together can pop out a valuation somewhere that is reasonable for where your company is. We actually build a tool similar to the one you saw with the co-founder equity split, but instead of asking about your co-founders, we ask about every little nitty-gritty part of your business, and we pop you out an actual valuation range. It's only good for companies up to, I don't know, Pete, like maybe 10 or 15 million, I think it tops out around.
Yeah, there's some caveats for location and industry and business type. We also do ask about your team because that factors in.
Yeah.
And do you keep into account the difference between New York and Boise?
Yep, we actually take location and industry. We take advisor team as well. Previous startup experience, previous C-level experience, previous exit. B2B or B2C marketplace, if there's subscription based as opposed to unit economics based. And we built that tool based on owning a valuations firm. So we had a 409A valuations firm. And what 409A valuations do is they do look at the funding rounds and all the pre-money valuations in their calculations, even though they're optimizing usually for a much lower value. But we took that base of, I believe, a couple of thousand valuations over the course of 5 to 7 years and kind of put it all together, as well as seeding it in with location data and stuff like that to come at, I wouldn't go through the tool and then be like, oh, this says $7 million. $7 million goes in Gust, give me my money. But it's a good range and it's a good thought process, similar to that co-founder equity split I showed you before, to just expose different either strengths or weaknesses of your company so far in the various ways in which investors will consider it.
Yeah,
well, can you post a link to that in the chat?
Yeah, let me grab
apologies in advance. My kids are home, so you may hear them in the background chatting about Pokemon. But one other, I think, interesting way to set expectations or thought processes around valuations, or at least a good way that I've found to think about it, is also thinking both from the investor side and the founder side. From the founder side, how much money do I effectively need to get to the next stage in my company? And how much of my company am I willing to give up to get that money? And then working back from there, like, okay, we know typically angels and VCs are looking for anywhere between 10 and 20% when they're coming in at each round. How much leverage and traction have I built to argue that this should only be representative of 10% rather than 20. So I think that's often a simpler way to look at it, and an easier way for both sides to think about it. Like, this is my ask, this is how much I'm willing to give up. This is why I think that's justified. Land that somewhere between 10 and 20 and just push around that. And that might be easier. It's still worth it to go through a tool like ours, I think, to understand all of the components that you can then discuss as you go through that negotiation. But I think it's a simpler way to intuit it.
Cool, thank you. So at this point, I'd like to open it up to questions. Does anybody have a question they want to ask?
There's a bunch in the chat. Oh, go ahead.
Yeah, no, you can pick through the chat if you want. I was going to make Michael Irving talk about oyster shells.
I'm excited.
Yeah, I've got to digest it all before I could really come up with a good question, I guess.
All right. So,
I know oysters.
but you know, you're setting up separate businesses for each farm, and as you do that, your complexity about what it means to have equity is going to be much higher than what the average software startup is going to have, right? You've got all these pieces, and you might share equity in one of the sub pieces to some person that doesn't involve equity in the other pieces. So there's some complexity there that you can bring up that the average software person's not going to even think about.
Yeah, that's you know, originally, I guess Alaska's best shellfish is the umbrella, and the other farms would be underneath it. But
and so if you share equity with, you know, like a partner, or, you know, let's say you get a co-founder, one per farm, are you going to put the equity for that co-founder in the farm, or are you going to put it in the umbrella?
I would like the equity for the co-founders to be in the umbrella, I guess. Okay. You know, that's the vision.
Now you're making a choice that has consequences. And Ryan, do you have any thoughts on those consequences? You know, to say it out loud, there's an umbrella entity. They're creating little franchises down underneath to limit risk and to manage the process cleanly. And they're going to need partners to do some of the work at all of these. So do you put the partners in at the bottom, or do you put them at the umbrella? He says umbrella. Any thoughts?
Not knowing the oyster shellfish company, other than consuming excessive amounts of oysters, especially ever since I moved to the shore, I would say you don't have to do either or. So the umbrella company seems like that can help de-risk the effort for all people, right? So everybody, it's kind of like if everybody who owned a McDonald's could also participate in, you know, McDonald's stock, so that even if one area doesn't work out, you're all adding to the same brand, you're all building and doing that. So it could be useful for both. Incentivize people locally who are working on the thing that they're going to make successful, so their local efforts, you know, could have some significant upside with ownership in that revenue generating piece. And then maybe also have, what is the thing from Founder Institute, Pete, called the Equity Collective, I think?
Yes.
Where it's like shared across all members of the program, so that everybody's kind of like a rising tide lifts all ships. As Alaska's best shellfish improves as a brand as a whole, you know, there's going to be some virtuous feedback cycles, I would imagine. You could do a little bit of both. Where you'd put the numbers, I think that really comes down to the business metrics and margins and unit economics that I have no bearing on.
Well, I think it's somewhat about incentives too, right? If the umbrella company is meant to expand through subsidiaries, and you have investors investing into that umbrella company, then that umbrella company better own a good portion of those subsidiaries. And on the converse side, if people have equity in the subsidiaries rather than the parent, their upside may be limited by what each subsidiary can accomplish on its own, rather than what the umbrella company can accomplish as a whole, which may actually be a larger mission, and a larger, you know, financial outcome.
Cool. We do have some cool things in the chat, but did you want to dive more into the incentivization there with the John?
No, I just wanted to get the ball rolling in the conversation. Ashley asked an interesting question that's worth talking about a little bit more.
Yeah, Ashley asked, what is the one thing you want to stress that founders do not do? Anything that comes top of mind. And I will elevate David's answer here because I've heard it time and time again. And it is definitely the David consideration of the highest of the high level is don't be cute. Don't fudge things. Don't fake it until you make it. Don't do all the kinds of things that are sacrificing your integrity in the space. You'll hear a ton of stories about like the deal that almost went sour when so-and-so faked this or faked that they had an advisor on their board that wasn't really there, but then they got enough thing and they made it, you know, by the skin of their teeth. And that was the thing that made them successful. That's not the kind of stuff that you want to rely on making your business successful. Operate with integrity.
Just
go
to
ahead,
double
John.
down on that, you know, we have the apocryphal story of, you know, people post up their team and they put up the investors and somebody in the room knows that investor and text them and say, oh, I didn't know you were at that company. And they text back, what company? I'm not part of that. And they've stopped the conversation. The deal is dead on arrival and they haven't even finished their pitch, right? So your notion of papering the advisor deal is important. And now expand that, right? There's a whole bunch of places where agreements are great, but if you haven't papered the agreement, you haven't papered the process, that follow through makes a difference when you get to the point where things start getting a little bit squishy.
Yeah, you never want to make claims, especially public claims that you don't have backed up. Yeah, I mean, even in my brief time working at Gust and just seeing all the companies and the thing, it's anything like that eventually comes back to bite a company. Get your things papered right, play straight, be open and transparent with people. I think there's like a negative, there's a lot of like survivorship bias and there's a lot of tendency to tell like hustle stories in the space, but it's an incredibly small space. People know each other. These are private networks that you won't have the exposure to. You think, oh, I'm in biotech. This is like some SaaS company. Like they'll never know. It's like people talk what do we got? 26, 30 people in this room today from all over the world, orchestrated by a thing. Like I will remember Alaska's best shellfish for the rest of my life. I'll remember the logo. I remember the conversations that I had with this. If somebody were to come up to me and like have that thing and be like, oh yeah, I work for this company. Like I might be like, oh, I didn't know you knew my friend this. And it all goes away. And people will say no super quick.
Right.
Always looking reasons to say no, right? And I think building on that and just reinforcing that, we had a company that we have partnered with come to Nashville today, and we met with them. And, it turns out that everybody else I know in Nashville is also meeting with them. So now, like even our partnerships, like everybody else I've talked to in Nashville is now imparting what they've learned about me to these founders. And every day we find those connections that run way deeper and way stronger than we thought. We were evaluating another partner, and turns out that we know 3 of their early investors, and a company that incorporated through Gust Launch is also evaluating them as a partner. And the ecosystem is small and it's tight. And just to reinforce also that any reason to say no, and David kind of mentioned this too, just in terms of like getting cute and writing things into documents. It's not just being nefarious. It's also just trying to be too covetous or protective at the beginning. We talked to 2 founders today alone where they had tried to set up complicated shares structures, encoding like 10-to-1 voting rights for the founders prior to pre-seed, and locking in all this stuff and trying to have somebody's brother hold some of the stock to retain like financial incentive. And just like, hey, it's super early. You do not have the leverage to pull this stuff off. You're spending way too much time thinking about this. You need to think about building your company and building your traction. That is what is going to get you the leverage to either take less money and retain more of your company, or argue for better terms in the future.
And one of the things that really helped me on my company is we had a corporate book that our board secretary kept, where we put all of the critical things in paper, in the book, in the folder. And so when people came to buy the company, we just pulled the book out and had everything available, which is not the stuff that was on the disk drive, but the stuff that was in the paper book. And it totally changed the conversation with the negotiation for the company. And so that papering thing is useful. And then to double down on this fake it till you make it thing, the fake it to the make it thing also comes in the precision of your language. When you tell me somebody's an advisor or an investor and they have not yet written the check, they're not an investor.
Yep.
When you tell me that somebody's a customer and they haven't paid you money, they're not a customer. And so you tell me you have 10 customers and then I ask you about your revenue flow and you don't have any in your cash flow, all of a sudden, okay, on to the next one. And I'm going to look at 1,000 for every 10 I invest in. That's the industry norm.
Yep.
So getting to know is very easy for the first 900.
And honestly, just for even outside of it, just makes good business sense in terms of like, as an investor, my time is important. And if I can find like one thing to easily say no without having to be like, oh, do I really think this market is this big? Oh, do I really think they can capture this much? Oh, is this the new future? Whatever. If the founder lacks integrity, that's the easiest thing in the world. It seems like a thing like, oh, I could clarify that. Like, it's such a huge opportunity. Don't miss this boat. It's like, nope, so easy to say no.
Yep. All right. Any other questions that people have that you want to ask?
It looks like there was some chatter about revenue-based financing, which is a bit of a non sequitur, but we've had a lot of good experience with that recently.
Well, let's dive into that because I think there's a little bit of magic in that. So
yeah,
we have a guy in town here named Looney Lives. He runs a Techstars style accelerator called Fledge.co. It is an impact accelerator that invests in impact companies. Impact companies often don't have the same vision about scale and are typically not angel investable if you're doing an equity deal because you're just not going to get the scale fast enough to make it worthwhile. Mm-hmm. And he's been investing in companies using what I call revenue redemption, where you're issuing stock, but you're buying the stock back at a multiple. So he'll put you through his accelerator. You'll give him 6% stock. He'll buy back that stock, some percentage of the stock at like 2x, 3x out of revenue, out of 4% revenue. And that gives you the ability to invest in any company that has rational margin. So I can invest in growth or I can invest in margin. And most angel conversations are only about growth. And then if I have not quite enough exponential growth, but I have margin, then I can do revenue redemption and get angel returns and invest very early. So someone like Michael Irving, who's never going to be a $1 billion company, might find that he can get angel investment through revenue redemption in a way that he can't get equity in his business, right? And Michelle was asking about using revenue-based mechanisms for offsetting costs with suppliers and contractors, which is an entirely different conversation. So
I think there's
in that context.
Yeah, so there's two really cool sides of it that are emerging. So what you're talking about, there's another fund out there called Calm Fund, who's invented their own fundraising instrument called a SEAL. And what that is it's kind of like an optional growth investment where they invest in a company. They have like basically revenue rights on a timeline of once the company meets a certain amount of revenue. There's some controls for founder and executive salaries in there too, so the founders can't basically just load their salaries up to make their company not profitable. But so if the company goes in more of a growth but not hyper growth mode, the investors can get paid back based on some revenue agreements. However, it can also just convert to equity in case the company is on a growth cycle. So if it's a business model that's like a risk of return, and they believe, their whole thing is make calm companies, don't be crazy people, don't go pump and dump. The other side of that, so it's like kind of blending the angel world into the revenue-based world and sustainable business world. The other side of that is some cool developments in underwriting, which you'll hear revenue-based financing more about, like pipe and cap chase. And that is where if you have revenues, like decent revenues, and those revenues are annual in nature, or they're at least recurring in nature, there's a bunch of these companies that are coming out that are offering non-dilutive capital by basically paying you out now for the revenue that they see you gathering. So say you have an annual subscription business, they could actually front you 30%, 60% of your ARR with a payout schedule so you can reinvest it into growth. So this is a really interesting thing. If you have a lever on growth for your business, like say Michael's like, oh, it costs this much to open up a new farm, it costs this much to operate. We know the margins are this. If we can get these up and running, we can grow, but there's just not all that capital sitting around. And then Angel's like, I don't see a 30x possibility in this deal. If there's existing revenues from the other farms, you could literally borrow against your own revenue effectively to funnel the opening of new things and actually get yourself on a rather exciting growth schedule. And there's a bunch of other ones out there. And an interesting thing that I know CapChase particularly has done is expense-based financing, which allows you to get after those upfront costs. The most common example is AWS. AWS, if you pay upfront for reserved instances, you can save a bunch of money, but you need a big upfront chunk that you might not have lying around, or you just might not want to take the risk of draining your bank account so much to get discount services. But you can actually use them to be like, oh, we can actually negotiate into these longer term, these bigger contracts, giving up a percentage of it, but allowing us to access deeper discounts overall.
So
Right.
Ashley is asking for some thoughts around how to give employees equity and how to structure that granting of equity or granting of options and structuring that flow of revenue component to the employees.
Okay, where is that in the chat?
Could you describe the step-by-step of actions to carry out giving employees equity?
Oh, yeah. So I guess this is the nuts and bolts. So say you have an employee. Do we mean common equity or stock options?
Well, how would you decide?
Yeah, that's a good question. That's a good question.
All right, so let's first start with your brand new company. It's just the founding team, but you want to bring an employee on. They're not going to be a founder level, but you want to compensate them with some equity. The first thing is, how far along are you? If you don't have an equity incentive plan yet, do you want to create one? This goes back to the stuff that we were talking about before, which is creating and running an equity incentive plan does have some upfront costs and some compliance to do. If you use products like us, it's a lot cheaper, but it's still going to be something to structure that plan and be sure that you don't fall afoul of any of the rules like Rule 701. And then also considering the nature of the relationship with this employee. If this is a key early hire and it's early on, a common stock grant might be, if you consider them an owner-like participant, it might be totally fine to do a common stock grant, put smart vesting on it to mirror, the terms of the employment relationship. Again, you'll probably see that 4-year vesting schedule with a 1-year cliff for key employees. And then it's a conversation. So let's say you're deciding to go ahead with a common grant. What is the role of this employee? Are they going to be a key hire, like a key engineer? What percent is fair? Seeing much more than a single percent for somebody who's not a founder kind of skin in the game is pretty rare unless they're an absolute all-star. But you could see fractions of percents, or maybe if it's like a super key engineering hire, small single-digit percentages. It's part of the negotiation of the compensation package for joining the company. If they're not getting paid salary at all and they're only getting equity, they're definitely going to have a higher percent, and that's part of the conversation. But if they're going to get, say, a below market rate, say this is a super senior engineer person that could go out and make $400,000 easily at some big tech company in annual salary, you don't give him $400,000 worth of equity. That's not how it works. Just because he can get paid that on the market does not mean that that's how much his efforts are worth in your company. However, you come to some kind of arrangement that's like, hey, we can pay you $100K and we're going to give you this percentage ownership, to compensate for the rest of that, and also communicate like the nature of it, like as we grow and scale, like what does that mean? Future tops up in equity, your salary increase as we make revenue and things like that. Once that negotiation is done and you have an agreement on kind of like all the parts of the package, you'll have an employment agreement, which most companies use a PEO or an HR provider, something like Gusto or JustWorks, or there's a ton of them out there now. So you want to be sure the employment agreement has that. And then you want to be sure you execute the actual equity grant. You get the board to approve the equity grant. So you want an explicit board approval of the individual, the amount, the share schedule or the vesting schedule. And then the CEO can execute that once it's been board approved, send it to the employee, and they should sign that along with their employment agreement. keep all those papers and or digitally signed things in one location, because that is the corporate history of your company. Like John said, the faster you can basically say, kaboom, here is the entire history of our company in time order, the much faster deals will go in the future, and the much less likely you'll be pulling your hair out with legal fees and accountant fees when something cool is happening. I miss anything in there,
why
Pete?
you need a board secretary. Just have a board secretary that knows what they're doing.
You can use platforms like Gust Launch to get you going. For a lot of that, we keep all your documents in one place. You literally get a time-ordered list of everything your company's ever done, from the simple signing of an NDA to something as complicated as adopting an option plan and things like that. But even if you're already, like, we usually only start with incorporated or unincorporated companies or very recently incorporated companies, which there's tons of companies in the planet. But even if you've already incorporated and done some of this stuff, it's really worth cleaning yourself up a little bit and operationalizing your back office and corporate decision making, because the wrench that can be thrown in the gears of trying to clean this stuff up is a lot, and the deal momentum can completely disappear if you have to, you get an exciting phone call with a potential investor and then you have to go and spend weeks of effort cleaning things up. They might lose interest by the time you get anywhere near there.
Yeah, just going back to the stock step real quick. Oh, go ahead, John.
It's not a might. They will lose interest, and once the expression of interest has been made out loud, you have this evaporation that happens in the order of 2 weeks, and then what was a deal that you could have closed is now one you have to fight for and add another week, and it's dead.
Yep.
Yeah, sorry, to get back to just the nuts and bolts on the equity stuff. Typically, the things that you want to be keeping in mind are tax consequences and monetary consequences for who you're granting to. So very early on, you can utilize common stock because it is still priced very low. If you utilize common stock, then the person getting that equity can buy it for very cheaply. They can file what's called an 83B election to limit, or in most cases, eliminate their income tax burden on the entirety of that grant. And it will start their capital gains holding period on those shares. It will also start the QSBS window on those shares, which can entitle them to a huge capital gains write-off. So early on, for early team members, as long as you are comfortable having them on the cap table holding common shares, it is very advantageous for them to receive common shares upfront from a financial perspective. As you build value in the company, your share price is going to go up. Once your share price hits a certain point, then for large grants, or even in some cases, smaller grants of equity to team members, that initial buy-in price gets really expensive. So either they have to pay that immediately, or they have to recognize that as income and pay income tax on it. So then it becomes cost prohibitive for the people actually getting the equity. And it's at that point that you typically start seeing people think about an equity incentive plan or an ESOP and forming that and taking on the additional administrative burden. Typically that comes along with some fundraising event and a hiring plan of somewhere between 5 and 10 W-2 employees. You're really starting to build a team, and the initial administrative cost is worth it.
Awesome. Yeah, that actually wraps up the majority of the life cycle that we went through in the presentation. Thank you for that. Is that helpful? That was Ashley, I believe.
Yeah, she says very helpful in the chat. So yes.
Great.
Any other questions? Cliff?
I don't have any questions yet. I'm still concentrating on building my business, so I'm not.
Turns out
I'm just soaking it in for right now, but
you don't get the opportunity, or you don't get the option to only focus on building your business without thinking about how the choices you make change the places your business can go. So a lot of these decisions they're talking about, you can't do 2 years from now. You have to do it while you're doing it, which is why we talk about it in the workshop, is to try and get
I think, I think one of the questions that keeps popping in my head, and based on a number of the, I guess, the more research I do, and I guess this is sort of the thing about research, you may get various answers, but I'm currently an LLC. I'm going to start as an LLC. I'm going to pick my vein and I'm going to go in my vein until it's time to change. I'm not seeking funding yet. That said, my question is, at what point is it right to go ahead with the C Corp? And I've heard, oh, you don't need to worry about that till you have 100,000 sales. I've also heard you need to do it before the first sale. So I can't get any clarity on that. And
so the clarity is really simple in my mind. If you ever plan to take outside money, do a C Corp. Just do a C Corp. It's cheaper, easier. Just do the C Corp. If you don't think you're going, if you don't think you know what your business is, and you're going to try a bunch of different businesses, then have an LLC to sort of be your playground as your R&D entity. And then when you decide what you're doing and what the new business is, form a C Corp for that outside of your play around thing, so that your play around thing is an R&D consulting company that you poke around and move money around to try experiments. But then now I'm going to build a trucking company. Then go build a trucking company, make a C Corp, make everybody solid because you've thought out your plan. How does that sound, Brian?
Oh yeah, you're doing our marketing site work for us. We actually have 3 questions that we use to help people navigate if they should go the C Corp or LLC direction. And it's similar to what you're saying, is if in the next 2 to 3 years, you think of the company as ever raising money from outside investors, ever granting stock options to employees as a form of incentive, or if the end goal of the company is an M&A or an IPO. If you're saying yes to almost any one of those, chances are the entity that you want to start and run after is a Delaware C Corp. And the more you start it and roll it as an LLC, the more expensive it is going to get to convert. Conversion is totally possible, but as you get revenue, as you get customers, as you generate IP, you're basically asking for thousands of dollars in legal and accountant cleanup to do that conversion, as well as the big distraction. You know, similar to what John was saying, is if you're running an LLC, there's a lot of things that are happening. The nature of the business, you know, I'm assuming that the business like has a purpose and a direction, and you found like, oh, we have use for outside money now, and we've talked to some investors and we're rolling this thing up, and the investor comes back off of one phone call and's like, we're in. We really want to pursue, like, we're going to start diligence. And then your response is, oh, hang on, we have to convert to a Delaware C Corp. A huge amount of momentum is just like, poof. And the costs of running a Delaware C Corp relative to an LLC are really not that much different. You're talking on the order of a couple $100 in annual filings and things like that. It's not really, I mean, I would say a decade ago, the governance structure of a Delaware C Corp, navigating it, paying the legal fees, ensuring you have a board, you have shareholders, you have executives, you're keeping your meeting minutes, you're keeping all those things, was more complicated than an LLC operating agreement, which was like, I'm the business owner and I do the things. Right. With the advent of platforms like ours, and there's other ones out there too, all that governance stuff is a click next to continue kind of thing and a guided experience. So even that overhead is largely just not there anymore. I'm sorry.
I do really love that idea of an LLC as your R&D arm though. That's the first time I've heard that and thought about it that way. And that's really interesting. Getting to validation, getting to the point where you're ready to actually go with the idea, then spinning up a new entity and, you know, pulling out the IP and bringing it over. I think that's actually really cool. And I think that's probably a more interesting approach than the one we typically see where people are converting.
Yeah, it actually makes me think there could be a cool product there that is an LLC that has a built-in path in its operating agreements and the way it gathers IP to make it very clean. Because even now, if you start an LLC and you get stuff going, you're still going to have to pay a decent amount of expense to assign that over to the new Delaware C Corp, deal with the income tax issues, deal with, you know, just the general lawyery stuff. But if you kind of anticipated that, I could see, Pete, I'll take some notes. There's a product in there.
Yeah, we now have multiple products to discuss with you, John.
Yeah, right. Exactly what I was thinking. Multiple products in my mind. I have no shortage of ideas. Anytime you want to dive right on an idea, let me know. Any other questions that people have?
Grandpa.
Yeah.
Somebody has a question in the background, I hear.
Yeah, she wants my attention now, and I'm spending too much time on this. Yes. Today being a holiday, she's not in school, so
yeah. We're dealing with that here.
Mine
I
are
hear
running
Pete's
around
kids.
in the back as well.
I've got a quick question. So my colleague Dante and I started the whole incorporation phase of our company through Clerky. Are you guys familiar with Clerky?
Yep.
Yeah, I'd imagine. Thank you so much for putting this on. Super informative. Like, and quite candidly, we were kind of stopped at the how do you actually issue shares part of the Clerky setup.
Yep.
Like, how do we want to go about this? So this has been super informative. Thank you so much. I'm curious if you guys could just help me get a better understanding of how Gust works in comparison to like my limited understanding of Clerky and how you guys differentiate.
Oh, sure. So we're actually, we admire Clerky. They have good legal formation documents, and they had a similar philosophy when they started in the space years and years ago. But we basically start the same place Clerky starts, but then want to stick with you for the next coming years. So not just set up and basically early governance, but we have a digital cap table that is updated with, whether it's shareholders, investors, convertible note holders, safe holders. We have agreements for pretty much everything that you could possibly do: contractor agreements, advisor agreements, NDAs, board management, so you can actually invite your board members on and they will get voting rights on future documents. We really keep basically a time-ordered list of everything your company has done from a back office standpoint, as well as events like this, education, support, knowledge sharing, office hours. We're basically there to be kind of like a software advisor that has done this thousands of times before to help founders through all those important things throughout the years.
Yeah, and those are the two
Cool.
big ones in my mind.
I imagine.
Oh, sorry. The cap table thing is a big one, but then also we are meant to be a founder first DIY when it's safe type platform, whereas Clerky was definitely built with bring your own lawyer in mind. So we are trying to help you get through all the stuff that it is safe to do on your own without having to pay billable hours for it. We will give you warnings when you are going outside the bounds of industry norms. We will have the conversation with you to make sure that you understand the question you have to ask to your lawyer, or even if it's time to go and talk to one. We keep a stable of startup lawyers that waive general retainer and offer discounted services. So our thought is like, absolutely, every startup needs a really good lawyer, but it's in their best interest to pay for billable hours on stuff that is strategic and specific to the business, not stuff that is part of the checklist that every startup lawyer keeps in their back pocket and runs down for every startup. So I think customer support philosophy, product philosophy, and education and cap table.
And
Awesome.
Michael,
Thank you. And
if you
safe
just
to assume that people go from Clerky to you guys.
yeah, as long as you haven't done a lot of if you've just registered, you can stop and just send us all your documents, and we can prepare an onboarding that will basically help you adopt bylaws, establish governance, grant stock, get onboarded to the platform, and continue. It's Clerky and Atlas companies are some of the easiest ones for us to onboard because they do good formation.
Cool. So
Thank you.
yeah, thank you. I want to bring it to a close. Before we do, I want to introduce Wes Johnson, who is our LLC organizer for SAC 20. SAC 20 will be on Wednesday, the 17th. Let me put the link in the chat for that. Wes, could you talk a little bit about your experience being the LLC organizer for SAC 20?
Sure, I'd be happy to, John. Yeah, so it's been a great kind of transition, from being a syndicated LP, from being an LP in venture funds, and being kind of a small player angel investor. I've gotten to grow some muscles in working through negotiations on term sheets with founders, working at raising funds. It's harder than most people think. And it seems like the minimum you give will be what's given for raising funds. But no, it's been an absolutely enriching experience. And I think it's made me a lot more empathetic to the founder journey, as well as really helped me grow as where I'm looking to go in the future as far as putting together deals and syndicating.
Cool. Thank you so very much.
Thank you.
We have a spin out that's happening called Apis Health Angels, which is actively going. So if you know a health company that would be taking pre-seed, please let them know about it. The deadline is December 1st. SAC 21 will happen March to May, and the assistant LLC organizer is John Dex for this round, who will be the LLC organizer for the next round. And we use that to build muscles to make that go. And so that process allows us to build this flow of producing new angels and more companies that are fundable. And so I think you heard in this talk with Ryan that the foundations of building your business and putting them together make a difference. They're important to do. And the process of having a stand and deliver where you're talking to an investor and you have to explain everything he just said makes a difference. And so looking at what he talked about and then walking through that and how you're going to explain that to an investor will be a really good exercise for you to think about how to do that. So thank you for coming. Thank you, Ryan. That was a great talk. Really liked it. We're going to put this onto the YouTube channel with a little bit of editing. We'll take the Q&A off of it, but the core presentation will end up on the YouTube channel. We have a med tech version of this happening in the evenings with Apis Health. If you've got a health-oriented one, send me a note. You can get to me through my LinkedIn. If you see the 3 little dots in the chat and you click on that, now's a good time to click on that and hit the Save Chat button so you have all of the information we put into the chat. We will do this again. We're not running the Thursday noon workshops from now until January. So this is the last of this calendar year. But we'll pick up with workshops both. Yes, you're the capstone, Ryan.
Feels great.
Pick up with these in January with Tuesday evening workshops and Thursday noon workshops as we go into SAC 1. So thank you all very much for coming. I surely appreciate it. Bye-bye.
Thank you, John.
Thanks all. Thanks for having us.
Thank you so much.
And
Thank you. Thanks,
I put
everyone.
Pete and I's emails in the chat. Feel free to email us any startup back office questions. We love to help, especially the Seattle Angel Conference community. And if you happen to have a C Corp or interested in it, we can onboard you through there. It'll be high touch.
Cool.
Looking at you, Michael.
Thanks so much.
Have a great week, everybody.
Hey, guys.
Bye-bye.